Hello, everyone, or hello again. Indeed, we made this year the Finance in the Future sessions a bit more open. It used to be only for investors, whether they were GPs or LPs. But I think it makes sense for the whole ecosystem, also for startups, to understand why VC thinks the way they do, meaning what return, what risk they can provide to their LPs. So maybe just to check, so who is in the room, who is an investor? Okay, so a lot of people. And are there any founders, any startups? So okay, some as well. So that's great. So you can ask some questions during the sessions. You can flash this QR code and you can ask the questions. And I should be able to read them here. And either we will ask them at the end or maybe during the conversation, we'll see. But yes, please do ask some questions. And yes, I think we will start. So maybe we can do a small round of presentations before I ask you some questions about this topic. So Chloe, do you want to start?
Yeah, hi everyone. I'm Chloe Dagnell. I work for Isomer Capital. We're a VC fund of funds focused on early stage Europe. So what does that really mean in practice? It means that we're backing pre-seed, seed, a little bit of Series A funds. We typically focus on funds that are sub 150 million in size, so really getting to things early. It's actually our 10-year anniversary this year. We're very excited about that. We've backed about 86 VC funds now with 40 VC portfolio partners, have an underlying portfolio of about 2,500 companies. And really the idea is how can we capture the best new things that are being developed in Europe today. So, typically when we first started, we were going geography by geography, looking for the best funds, in London, in Paris, in Stockholm, etc. And as time has gone on, obviously the ecosystem has somewhat matured, and that now looks like we're kind of cross-hatching and layering on top with more sector-focused specialists. So a lot of deep tech funds in there as well.
Hi, everyone. Seth, Bannon, founding partner at 50 Years. We are a pre-seed and seed deep tech VC firm based in San Francisco. We partner with founders that are building things civilization needs. So not yet another marketing automation, whatever. And we also run a deep tech company creation program called 50/50, where we help scientists in academia and engineers from places like SpaceX and Tesla and Anduril start companies.
My name is Bas van Beijeren. I'm with Carbon Equity. We're a climate tech fund of funds. So we invest from very early stages, pre-seed, seed, to late stage growth. And on the side, we also run an infrastructure fund of fund, really focused on Europe and US. And via our co-investment program, we only invest in the winners in our portfolio.
Thank you. So the first question, it's about what's driving LP investment. So is it really about return, or is there something else? So it's more for Chloe and Bas, this question for the two LPs here.
Yeah, maybe I can jump in first. For us, it has to be about returns, right? If you're building a fund of funds portfolio, you have to be extraordinarily focused through that diversification on finding the best funds and the best performance there. Otherwise, it just doesn't make sense, right? Go and park your money in a different asset class that has shorter liquidity cycles, etc. So what does that really mean when we're looking at Europe and we're looking at the European landscape? Well, we're looking at where great talent is building, right? So the ethos of Isomer is how can we support the best European entrepreneurs to build their businesses? From our home in London, we don't feel like we're best placed, to develop our own seed fund and to try and get the best deals, but really, to capture everything that's being built in the Nordics, in Central Eastern Europe, in Southern Europe, in Western Europe. And so that's been building a diversified portfolio with the very best GPs that are out there. So it has to be about finding those that are really getting into the top performers, that are finding the best talent in Europe. And what we do see is that the best talent is flocking more and more towards purpose-driven companies, towards deep tech, right? But that's how we make our decisions, is really where is the best talent going, because that's what will drive the best outcomes.
We have a relatively similar view, but a bit different. So at the core of what we do is really making sure that the funds we invest in the companies can drive meaningful climate impact. So at the core of what we do is we want to look for impactful businesses that solve big climate problems. But our thesis is as well, like, if you're going after a big problem and you have impact, you must have hundreds of millions or even billions of revenue. So we do believe the two can reinforce each other, and you can have both of it, but we always start, what are you investing in and is that impactful? And within that ecosystem, we try to find the best funds that actually have the capabilities to scale these solutions and really make them successful. But it also means we cannot only invest in Europe. So the way we build our portfolios, we have 50 to 60% exposure to the US, a bit more proven markets, well, on many financial fronts, but also in climate and especially deep tech. We need to invest in the US as well to build the best diversified climate funds.
Okay, thank you. And we've seen that compared to maybe 10 years ago, where deep tech was not even a term. Everybody cared about B2B SaaS and e-commerce, maybe not in the US, but at least in Europe. Today, deep tech is actually the major asset class in tech in general, in the VC asset class. Why do you think it's the case? Why it's becoming the dominant today? Maybe starting with Seth.
Yeah, I mean, at the end of the day, deep tech is about giving humanity new powers, right? Almost all of software is about taking something humans can do and allowing us to do it a little bit more efficiently. And like, that's kind of cool, I guess, but it's not as cool as enabling the species to do things it literally couldn't do before. And so I think this is a huge driver of investment in deep tech and interest. The other huge driver is that the cost of making software is going to zero. It's getting abstracted away, where already people who have an idea over a weekend can fully code and launch a thing. There was just a video game that got launched, and it's kind of fun. And this person doesn't know how to code. They made it with a no-code tool. And so as the cost of software and the time it takes to build software goes to zero, the impediment to progress becomes things that are built in atoms. It becomes factories to make things, right? And the value of the scarce thing goes up, and the value of the abundant thing goes down. And so it's entirely possible that all of software will just start to lose all value, because there's literally potentially no competitive moat at all. It's funny because for the last 10 years, people thought that SaaS investing was like normal generalist investing, and that deep tech was sort of this weird specialized thing. It turns out that SaaS was likely a decade-long fad. It was a fad. And we might never talk about SaaS 5 years from now. And 10 years from now, people might go, well, SaaS, what was that? Right? And so I think this is a big reason that there's a lot of LP interest now, is because people are looking at their portfolios full of these SaaS software companies and saying, my God, which of these might have any sort of differentiation? And I just want to quickly touch on the last point. We've assembled an amazing LP base. We have, one of the top UK universities. We've got Morgan Stanley. We've got Sequoia Capital. We've got 55 unicorn founders, including sort of top 5 market cap founders. And I think returns, obviously it matters, right? 20% of the teams in our first fund, all back from pre-seed or seed, went on to become unicorns. People like returns, you sort of need that. But I think LPs, they also want to be doing things that matter, right? And I think especially now, where we're in this age where we literally might be creating something akin to gods, I don't think anyone wants their kids or grandkids to be like, oh, mom, dad, what were you doing in that amazing time when we were creating these gods? And for that person to have to tell them oh, I was, backing, marketing automation, artificial intelligence, no one wants to say that. And so I think people, when LPs back deep tech firms and they look at the companies that those firms are backing, they feel good about it.
I mean, we're all technology geeks, so we do get really excited about what is in underlying portfolios, right? That's obviously part of what drives us. But I think what is really driving that underlying excitement is as you say, the market opportunity. How is this going to change the world? And those opportunities just feel so much bigger than when you're doing a specialized vertical software in B2B SaaS, right? It's just not as big of a market potentially. So that's really how we're also thinking about it. I think for me, I see it kind of in 3 ways. So you have that bottom-up push, which is coming from, AI developments, which are in fact making some of the B2B SaaS companies in our underlying portfolio get extraordinarily nervous, right? I think unless they pivot or manage to integrate some sort of AI agents into their software very quickly, these kind of companies that are sitting somewhere around the 10 million, 15 million ARR mark are just going to get displaced very, very quickly by something that's doing it better and more efficiently and is kind of AI native. On the other side, and pushing from the top down, you have everything that's going on in geopolitical sphere, right? So you have a renewed interest in defense tech in Europe, for example, with the Ukraine war. Again, you have a renewed interest in climate tech. We saw that in the early 2000s, but again, it feels more pressing than ever. So I think you have this downwards push from the top too, and then you have sideways that the talent is just becoming more and more experienced and is ultimately looking to solve some of these problems. So we just made a co-investment in a company called Latent Labs, led by a CEO called Simon Cole. So he was working at DeepMind before and worked on the AlphaFold 2 project, which just won a Nobel Prize. So, these are really, really talented and exciting founders that are now kind of leaning into the deep tech space. And of course, that's where we're going to put our money, and that's where we're going to follow these great opportunities.
We just wanted to invest in climate, and you end up in deep tech. We never started, let's do deep tech. We also do software, and we try to build balanced portfolios. But I think a lot of LPs that want to feel good about their investments and pick certain themes, they just end up in deep tech, which is also a bit of a scary thing because it also happens at the GP level. There are a lot of people chasing momentum and going into climate tech a couple of years ago, quantum computing, AI. But also LPs, recently spoken to a few LPs who were looking at a lot of climate tech and, oh, sorry, we deprioritized it. We're looking at defense tech and quantum computing now. So I think deep tech is super interesting, but it's also very easy to lose a lot of capital, both for GPs and LPs. So it's a market where you need to navigate very well.
Actually, that's one of the questions I have here, because yes, it's bringing more and more interest. But what about the returns in deep tech? And by the way, this afternoon I'm promoting a bit another session because we created last year our own VC fund, and we did some studies, and so we'll share the results of how have been performing the startups from Hello Tomorrow. But it's about you today. So what about the returns in deep tech? Any insights you can share?
You have a 10-year portfolio.
Yeah,
Go for it.
I can talk about our portfolio. So look, I think the really, really hard thing when it comes to Europe is that it's still relatively young, right? So most of these funds are on their funds 2s, fund 3s. The funds that are out there on their funds 4s, 5s, 6s, they're the B2B SaaS funds, right? And they've been backing software for the last decade or two. So it makes it incredibly hard to diligence these funds. And so, yes, we look to the US and we look to counterpart funds there to try and benchmark and see what the possible returns can be. But we need to have entrepreneurs that are chasing that sort of mega scale here too. And so then we start having questions around European mindset and things like this. But ultimately, we feel that deep tech can return great portfolios. You have to be disciplined. You have to think about your portfolio construction a lot. I think one of the things that makes us quite nervous is generalist investors that are now making their way into deep tech and trying to structure rounds in a very, very similar way. And we know that these companies might require more upfront capital. They might just take longer to get to product market fit. So essentially, we're trying to drill a little bit deeper into, okay, well, what does your portfolio construction look like? Are you really understanding how these companies are going to grow and how they're going to grow differently from the B2B software companies that you've been investing in for the last decade? And we're fine with generalist investors, taking a swerve to the left to look at this market. It's incredibly exciting. And ultimately, we would feel like they would be getting left behind if they didn't take that swerve. But they need to have spent a lot of time thinking about it, right? And that's what kind of makes us nervous around the current situation that we have.
Yeah, we're one of the very few deep tech firms that are on a Fund 4. And so we can talk a little bit about our performance. We can now because we're not raising, so we can legally do that. In the US, they're pretty strict about this. So, I mean, all of our funds are in the top 5% or top quartile. I think our worst performing main fund is at like 27% net IRR. We've more than returned in DPI, our first fund. So at least in our case, it's working pretty well. But there's a guy named Leo Polovitz who used to be a general partner at Sousa Ventures, which is one of the sort of top software investors in Silicon Valley. And he's an engineer, and so he got curious about like where do returns come from in VC investing. He started pulling all this data and doing all this analysis, and guess what he found? It was deep tech. And now he's actually sort of founded a deep tech focused firm called Humba, but he posted his findings. And it's really, really interesting in that a lot of the myths of deep tech investing are just that, they're myths. The time to liquidity is basically exactly the same. The dollars invested to exit value is basically exactly the same. Things like failure rate are exactly the same. On every single metric that matters, deep tech performs as well, or in some cases better, than non-deep tech. And this analysis took out biotech. So it's like traditional biotech. So like I have a small molecule and I think it treats Alzheimer's. It sort of carved that out because that's a sort of like own type of investing. But if you look at every other type of deep tech investing, and I encourage you all, I don't remember the name of the post, but if you do Leo Polovitz's deep tech, you'll, I'm sure, find it. But a lot of these things are just myths. It's never been true that deep tech takes longer for liquidity, that it's radically more capital intensive. You think about Uber. Uber raised over $20 billion in equity dollars. Equity dollars, right? That's incredibly dilutive. If you look at a lot of deep tech companies, though they might have to raise more, they can often tap into project finance or debt finance, which is completely non-dilutive, right? And that's a type of capital that a SaaS company just simply doesn't have available.
In a study we did with BCG, we showed that for the first 6-7 years, there is more capital needed in deep tech because there is this R&D phase, but this capital is used to build IP, to build a moat. And therefore, the rest of the growth is more sustainable because you don't need to spend it all on marketing to fend off competition. So in the long term, actually, deep tech is less capital intensive. And
this is one of the reasons that we are very active in the US, thanks to the likes of Seth that have been doing this for a long time. Like the deep tech, and especially early stage, is just very capital intensive. And at least in Europe, we see more the capital stack growing and more growth funds. But also the early stage deep tech funds in itself tend to be way smaller than our US funds. We have US funds that do seed with a $500 million fund that continuously can follow their winners and actually help them raise this follow-on capital and get them through this, well, famous valley of death. So in our US portfolio, we see many proven managers that indeed have been around for 10, 12 years, shown DPI. They've been early in very exciting deep tech startups. But in the US, in Europe, I think we're a bit behind the curve. But we're growing, and there are more funds going out there raising their second or third fund. So, also if you look at from an LP perspective, I was chatting to Chloe before this panel, and I told her your life will be easier in a few years to join our portfolio, because if you're really purely looking for returns and you're looking at a second generation climate fund where there's a lot to like, but they don't have the DPI yet, and you're comparing them to any other B2B SaaS fund that has a fund 3 or 4, it's so much easier to go to your IC with this B2B SaaS fund, even though Seth's vision that this is over. But climate will see the same. They're also in Europe, there are super exciting climate funds that will be back in the market this year, next year, raising their second, third, fourth generation vehicle and actually having DPI. So I'm hoping to see more LPs also tap into the European deep tech climate market.
B2B SaaS is only over for the smart LPs.
I like it.
so if you want to see some good DPIs in deep tech in Europe, maybe you need to wait 5 years. But if you want to be one of the lucky LP that get this DPI, then you need to invest now.
You just need to work harder to get conviction. Like for us, it's different, right? We have a mandate. We just want to do climate, and within climate, we find the best climate funds. So half of the funds we look at, they're also generalists looking at it from a really return perspective and actually in it. The other half, generalist LPs also look at it, but they think it's just too emerging. Let's just wait out. We take a bit more risk. I really believe with some of the funds, we're going to get heavily rewarded for it. And some other funds won't perform. And that's part of it, of an emerging market. So I truly believe you can get good DPI also in climate in Europe, but you just need to do more work to build the conviction and take a bit more risk and hopefully get rewarded for it.
Maybe for the founders here who doesn't know what DPI is, it's the money that LP gets when the fund is closed. So really, it's at the end of the cycle. So that's why it takes a little bit of time to really prove the DPI.
And it's like literal cash that you've given back to your LPs. So if an LP has given you $100 and you've given them $100 back, that's 1 DPI. If they've given you $100, you've given them $200 back, that's 2x DPI.
And we'd like at least 3.
It's true. What does a good investment thesis or good investment strategy look like in deep tech?
You want to go first, Seth? I think you might have one.
Sure. Yeah. I mean, I think that this is a bit contrarian. The biggest thing that we think is really important for doing deep tech well is to not be thesis driven. In B2B SaaS, say you're from like a Cell, right? Cell likes to find an industry where they're like literally using a fax machine somewhere, or something's on pen and paper, and they like to go, oh, that shouldn't work that way. They should have a digital tool. And they sort of map out sectors where that's true, and then they map out companies that digitize that, and they go back to the company and they make the connections. In B2B SaaS, that kind of like thesis-driven top-down makes a lot of sense, and you can do it well. The nature of every really profound deep tech innovation is that everyone smart knew it was impossible, because it was, right up until the moment it wasn't. Right? Because 5 to 10 people in the lab just figured out how to make it work for the first time in human history. And so if you are a VC and you like whiteboard where you think the world is going and say, oh, okay, then we want to have 20% here and 15% there, you will be completely wrong. And so I think in order to do deep tech well, you have to not be thesis driven, you have to be network driven, where you need to make sure that you are somehow adding value to those 5 to 10 people in that room, so that when they have that breakthrough, hopefully they come tell you about it. And then, yes, you need to have the ability to not only diligence them as founders, but to diligence the technology, to say, okay, is it actually possible? Is it scalable? Do the techno-economics make sense? And so this is probably our most sort of contrarian belief about deep tech investing, is that of all sectors, it is the most important sector to not be thesis-driven. We literally have patches on our jackets that say beginner's mind to remind ourselves of this. As soon as we start forming opinions about how sectors might play out, we sort of point to the patch and stop ourselves.
Yeah, I would disagree slightly in that, you can identify areas where problems are, right? Whereby technology is lacking and holding us back. And so going and spending time exploring those areas and seeing what solutions may or may not be developed. That's not to say that you will definitely pick the right one, right? But you start to explore and map out areas, and we've seen that work quite well for a number of our funds. And also it allows you to build up some sort of intelligence around these areas, right? Which means that when something comes across your desk, you can spend less time on it and get to an answer quicker in that DD process, essentially. So we feel like there's a little bit of thesis that needs to be behind something. If you're, we like funds that are maybe more driven just around biotech or just around a certain specific in deep tech. And that's how we would diligence things, and then go look at people's network there, their experience, what they've done there before, that gives them a right to play and invest in that market.
Being knowledgeable and informed about a space helps you spend less time diligencing it. That's very different than forming a thesis around that space, right? And so, we should definitely be smart. We should be informed. We should read all the papers we can read. We should talk to all the people we should talk to. But then we should not form any opinions around how that space should play out. That's, I think, where you get into a trap.
A lot of the markets we focus on, I think there's not a lot of market risk. Like, if you can produce energy cheaper and greener, there will be demand. We focus on a lot of things, but especially in the current market, let me highlight 2. So I think the capital intensity of a lot of the deep tech startups, and especially also for Europe, where the growth markets are less mature. So when we talk to GPs that do early stage deep tech, depending if it's pre-seed, seed, or A, you talk about different things, but we really want to understand how capital intensive is this business. Where are you going to get the capital to scale this business? We're in companies like Redwood, Form Energy, Vervo that raise in the hundreds or billions. Is that capital stack there? And on the other hand, from an economics perspective, when are you, from a cost perspective, where that you can actually raise these growth rounds? And eventually, if you can become commercial and really have multiple clients, how many multiples or multitude are you actually cheaper and more efficient than the current alternative? Because having a technology now that might be 20, 30, 50, 40% more efficient doesn't mean it will be picked up in 5 or 6 years as other technologies become more cheaper, and especially a lot of the deep tech stuff we do also require whole infrastructures and value chains to move with you. So really, from that capital intensity, cost perspective, related to the market you're targeting, do you actually have a fair shot at getting there?
I agree with everything you said but one, which is where will future sources of capital come from? I mean, is this early stage? Like, are you backing like seed, pre-seed, A?
So for pre-seed is too early, but when you talk seed, A.
Okay, great. Yeah. So for the best seed partnerships, you should be really worried about where future financing is going to come from, because the best time to be backing any sector is when it is the right thing to be backing and non-consensus. Right, so you obviously have this grid of like right and consensus, right, non-consensus, wrong, consensus, wrong, non-consensus. And like almost all the returns come from being right and non-consensus, right? And so, and those always look like the broader markets are like, oh, I don't know about that. It's like a great example. If you were to 5 years ago talk to pre-seed or seed companies in defense, you'd be really worried about where they were going to get follow-on financing, because like Silicon Valley doesn't back, defense companies, weapons of war. Right? And now 5 years in, it's just so easy for those companies to raise because that's the hot sector. And the time you want to be backing those teams is when it's not yet the hot sector, because that's when competitive pressures are lowest. So we always want to be a little bit nervous about where follow-on financing will come from, because if we're not nervous about it, it means we're too late.
I have agree. The money 5 years out is fine, right? I'm with you, and with defense tech, you can get lucky in this case, or unlucky. It depends how you look at it. But a lot of the companies we see in climate tech that do a seed round, their A is 18 months around the corner and can be huge already, and you need in the whole capital stack all kinds of other capital as well to get your first of a kind plant financed. So I'll rephrase, to at least 2 years ahead.
Now I agree.
You really need to have a good game plan, but also your own fund size to support it, or a consortia on the cap table to support it, and have a plan for 5 years out, because you don't know how the world will look like.
So you mentioned defense, and I think that's an example where the current geopolitical situation is having an impact. If you think about also the interest rates, so in general, like how does economic and geopolitical situation is impacting how you look at GPs from an LP point of view?
In Europe, things have changed a bit, obviously, because interest rates, but the biggest change, obviously, we see is in the US, given the recent administration, and we do a lot on climate. We're still very bullish on climate, that there are a lot of themes you can still invest in that either the Trump administration is still okay with or actually quite bullish about. Like geothermal is really flying in our portfolio, nuclear is really flying in our portfolio, really like new tailwinds, and there are a ton of technologies that from a cost perspective just really make sense, or that some of the oil majors are still excited about, which also helps. But there are definitely pockets in the US where we're more careful, where there's a lot of regulatory risk. And that's not easy in the current market. So when we look at GPs in the US, we, especially if it's early stage and there's regulatory risk, we're more careful. But obviously these GPs also understand it, and they have wide mandates to invest in, and they navigate. But I think climate, early stage, deep tech in the US has changed. The branding of some of the funds has changed. It's not about climate tech anymore, but energy abundance, or like we see a lot of interest in critical minerals, being more independent of Asia. So there's still a ton to like in the US, but it has changed over the past years or months.
Yeah, I think fundamentally it's always about backing businesses that will create real revenues, and not just for a moment in time that it works in this geopolitical sphere, but long term, right? The Trump administration is hopefully only 4 years, and then we'll hopefully move on. Who knows how long this war is going to be going on in Ukraine? Hopefully that will come to an end much sooner. But I think it has woken Europe up to the fact that we need to be thinking about our own defence capabilities. So I'm sure that there will be some sort of long-term change there. But you shouldn't really be backing something just because it works right now, right in this moment. We should be backing things for the long term, and as Seth says, for humanity's like development over time, right? And that's what's really going to build long-lasting and generation-changing companies. So that's how we would think about it. I think we get slightly worried that we all of a sudden see an influx of defence funds because ultimately it's people jumping on a market trend. Quite often they don't have experience in the sector, and so it's for us that makes us nervous, right? That's chasing capital because capital's on the table right now, not because you really long-term believe in the opportunity set and the entrepreneurs that are building in that space. So that's how we really think about it.
As the American on the panel, I was really hoping we wouldn't talk about geopolitics. I'll just say I'm sorry. I'm sorry. We'll do better.
Thank you. So I'm trying to go to the questions now, and there is one about talents, and you say that it should be network-driven. And how do you make sure you also have a diverse pool of talents, and including underrepresented talents? Do you do something special about it?
We went through a whole exercise to try and solve this, and what we found was pretty bleak, especially for deep tech. We looked at NSF probably they don't anymore, but they used to publish statistics on the gender and race of everyone who graduated with a PhD in the United States and postdoc. And for instance, in the last year we checked 1% of biophysics PhDs were black. In 1 year, there were 0 black AI PhDs. And so for sure, I think there is actually a pipeline problem. I know people don't like to say that because it's an easy way of saying, oh, we don't have to do anything about it, there's a pipeline problem. But there just is in deep tech. I think for gender, it's much easier. In terms of if you look at like bio PhDs, it's like pretty evenly split. And our bio portfolio is also pretty evenly split. And so yeah, we sort of butter our heads up against the whiteboard to try and think of initiatives that we could run to help solve that, and just at the end of the day decided it was just out of scope and it would take too much of a lift for a little VC firm to solve.
Yeah, we've actually looked at the same data, and it's really sad. But obviously, that's not something that we as an LP can change. I think the angle that we take is that we have a very open door policy, right? So if you're raising a fund or thinking about raising a fund, then we will always take a first meeting with you to get to know you, to understand what's driving you to do that. And that's kind of our way of making sure that we see everything on the market, that we're not an inaccessible LP that is expecting people to have had a long and luxurious career before them, but to really understand, what value can they provide these entrepreneurs that are going to be building great companies. And so that's how we see what we can do about contributing to the diversity problem.
I think our portfolio is also not very diverse. I do believe in climate. It might be a bit better as it's more purposeful driven, and it also does not only attract white males. But if you look at our portfolio, it's still an issue. We discuss it internally as well. If we also try to solve for this within climate, we're not going to end up with a great portfolio anymore. So we're really optimizing for the best climate outcome. And we pay attention to diversity in our manager selection as well. But it's not top of our agenda at this stage. The climate ecosystem is emerging already. It's not that we can choose between 50 to 100 great climate funds every year, and within that also select for diversity. I think that's also the honest answer at this moment. Hopefully in time we'll do better.
I have someone here asking a question about why there is so little focus on social sustainability and mental health in deep tech. I have a beginning of an answer because looking at all the startups that we screen through Hello Tomorrow, we see that deep tech has a big impact in climate, in healthcare in general. But it's true that social SDGs, it's poverty, issues with politics, with gender equality. It's not so much about the technologies. It's a bit more about the society that we're building. I don't know about mental health. Have you been investing in mental health, Seth, or do you? Yeah.
I think, on the more social side of things, we find more impact in companies that are, for example, working in fintech and things like that. Like you say, we just haven't really seen solutions that are driving change in that space from a deep tech lens.
Yeah, my guess would be, if we go back to what I said about deep tech earlier, where it's about giving humanity new powers, my hunch is we have the powers we need to solve those things. And therefore, the solutions are less likely to be deep tech solutions. They're more likely to be classic software solutions or societal solutions. I will say sometimes deep tech impacts, say, a lot of the SDGs in ways you wouldn't expect. So we have a company called Astronis. They build small geostationary satellites to cover the Earth and internet. They can provide internet far cheaper than Starlink can. And study after study shows that if you bring a population online that didn't have access to the internet before, basically everything gets better. Gender equality gets better. Educational outcomes get better. Health outcomes get better. Basically every metric you care about gets better. And so that's an example where it is a deep tech company. They literally build satellites and send them up, but it actually can contribute to a lot of these problems that you might not expect a deep tech company to be able to.
Yeah, we don't look into this market, but I do agree with Seth that a lot of the solutions we invest in have multiple magnitudes of impact on different markets, being deployed in emerging markets or creating new jobs or getting people access to things they hadn't access before. But other than that, it's really out of our scope.
A question for Seth. How many rooms can you hang around in? Apparently you are everywhere, so maybe you have a twin, I don't know.
I just have a lot of caffeine.
Yeah, exactly. A question, what role do corporate play in the LP base of deep tech funds? Is it more important than in traditional fund because maybe they are trying to externalize part of the R&D? Any clue? Yeah.
A lot of the funds we invest in, especially if they're a bit more focused, so they're like really climate generalist, and it's tougher to get a lot of corporates and utilities on board, but their funds really focused on really the energy piece, where we see a lot of the utilities as LPs, and that really helps to check if solutions are actually real issues for them, and like especially if you want to work with utilities, like they're obviously it sounds like a great client, but they're so tough to get as a client, so having them early on, that they actually like this, that it solves a pain point, and that you can do a pilot with them, and then you can actually become a client. In certain pockets, it's really important. I don't think they bring a lot of capital, to be honest. It's really more for them to get access and really hopefully help portfolio companies, and they'll just write a minimum check to get into a fund. And I think that's a great relationship, but from like LP quantity in dollars, it's not a huge market.
I mean, it's definitely for the corporates, it makes a lot of sense because they get to see the technologies that might be coming over the next 5 to 10 years that might disrupt their core businesses. I think for us, the question is always, why do we want them as LPs? And we want every LP to help us help our founders. That's kind of like the only thing we care about. And so, in our last one, we brought in a firm called Henkel, which is like a German chemicals company, because we back a lot of teams in the chemicals and material science space, and they have an amazing network there, right? And if we need to set up a call with one of their scientists to get smart on a thing, they'll do that for us. And so I think definitely there's a lot of interest, sort of inbound interest from corporates. I would definitely suggest if there are corporate LPs to think hard about how you can add value to the portfolio of the GPs that you want to invest in.
Yeah, and just to confuse any startups that are still in the room, we also have LPs sitting one layer above us. The capital stack just keeps on going up and up and up. And some of those LPs, we do have some corporate LPs, and the reason that they back Isomer is, like Seth says, to see the trends and see what may be coming in a number of years. The nice thing that we are then able to do is when there's alignment between our underlying portfolio and some of our LPs is facilitate those introductions. And we've actually had a few pilot examples happen in our underlying portfolio, which has been pretty cool to see.
Thanks. I have another question here. What does a great emerging deep tech GP look like?
It's all about GP thesis fit for me. So, why is this individual or this team of individuals looking at this opportunity right now. And that varies from GP to GP broadly and greatly, right? We do a lot of emerging managers, so people that don't really have much track record, and you're really trying to dive into, well, what have you done before and what gives you a right to access the best companies? What's your network like to actually win those deals? But then how are you going to go on and support them? And then critically, the third piece is how are you going to be a great fund manager? Do you really understand the portfolio construction that needs to come together to deliver that 3x DPI at least? But it's completely impossible to give you a non-fluffy answer on that because it is so individual to the individuals that we're backing.
I'll give a non-fluffy answer.
Oh, please.
I would say I would want. My ideal would be a engineer who maybe spent 6 years at SpaceX. And has a deep network among SpaceX, Tesla, and Anduril engineers. I think those companies are going to be churning out incredible founders very, very quickly. SpaceX and Tesla in particular, because they dream big, which is great for founders. They have great engineering cultures. They're sort of chaotically run, and so that prepares you well to be a founder. And frankly, a lot of engineers at those companies now don't want to go home for Thanksgiving dinner because they're.
Is that your background?
No, it's not. No, not at all. I'm not selling my own book. I'm giving.
GP?
We don't have anyone on the team with that profile, actually.
So you are the exception, or
what?
You are the exception then, or?
Oh no, I'm just saying this is a new emerging manager. I don't think it would have made sense when we started 10 years ago to have this profile. Now I think it does. And a lot of the team, a lot of those engineers don't want to talk about Elon at Thanksgiving dinner, just to throw it out there, right? Because they're like, they go home and their parents are like, oh, I saw this tweet where and they're like, oh, just please, I don't want to talk about it. And so a lot of them who never thought they would leave, who thought they would be there until we were on Mars, are like, I just don't want to work here anymore. I just can't stand the drama. And so I think we're just going to see a flood of amazing companies coming out of those 3 companies. And so if I was looking for a sort of emerging manager GP, I would look for someone who has a deep network in those companies and who themselves is an engineer, so they can really empathize with those folks.
I would love to see that person on a new emerging GP as well, but really combined with someone from the industry as well. We've seen so many emerging GPs with no one who actually had venture capital investing experience, and they just struggle on boring things, but super important things, like really messing up your fundraising. So it takes 2 years to raise your first fund, where you're out on the market, on the road all the time, instead of talking to all the cool founders. And I think if we look at some of the emerging GPs that are doing well, a few of them, what they do really well is really create kind of a platform and a name for themselves. Also, this sounds fluffy, but we have some US GPs really emerging, have 100, 200 million assets under management, but everyone in Europe knows them, everyone seems to like them, and they just get access to the best deals. And we also have that here in Europe. A couple of GPs, rarely a few, but they've really created a name for themselves, and people want to work with them. And there's not a specific reason why, but people seem to like them. They do well, and you get invited for the best deals. And I think that's also really important.
Oh, also because I talked earlier about how I think in deep tech you want to be network driven, not thesis driven. Right, so even like the SpaceX, Tesla, Anduril is an example of a network. Another thing you might look for is a fund that had built out a network that was super deep in some ecosystem, say Europe, where they had a name among all the deep tech ecosystem players, investors, LPs, founders, and maybe they were thinking about taking that incredible ecosystem that they built over the last decade and turning it into a fund. Yeah, maybe look for that. Maybe look for that.
It's a great idea. I have a last question. It's what does philanthropic capital play in the LP stack of deep tech fund, especially in the current context?
We sometimes find it hard to work alongside philanthropic capital because it has different outcomes to what we want. So I think that this is actually something that we've seen happen in the climate space a little bit over the past few years, is that there was some LPs that were extraordinarily interested in impact and, measuring everything to the nth degree. And there was other LPs that were more interested in, okay, well, how do we build great businesses that are going to make great returns? And sometimes, finding that alignment has been hard, but I think it can be great because ultimately it's purpose-driven and we're trying to build some solutions to better humanity, right? So we work alongside them. We love to see them not push too hard GPs in the direction of measuring for the sake of measuring.
I mean, we were super frustrated with how long it took to get scientific grants, and so we launched a program called Manifest Grants, where you can apply, and within 3 weeks, we give you a decision, and we give you a grant. And that's, for instance, just funded by philanthropic capital, right? So that's like a separate vehicle. It's literally a nonprofit vehicle, and a bunch of RLPs and some people who aren't even RLPs have backed that. And the goal is to fund science that has translation potential, right? So that has potential to then turn into a company. It's really hard to raise money for that like $60,000 experiment that you need once the basic science is done to show that there's a potential for a company there. And so we just grant that. So that's one way that philanthropic capital literally fits into the deep tech ecosystem.
Thank you. 10 seconds left. Anything? Do you want to add anything?
Well, very brief. Like I think in the scale-up phase, especially when you want to build your first-of-a-kind plant, there are pockets from the EIB or Breakthrough Catalyst program that they're instrumental to some of the portfolio companies, and especially at this later stage, different type of capital is really important and instrumental.
Sorry. People calling me to go somewhere else. Well, thank you very much. Last sentence, last thing you want to share with the audience? Or, yeah?
Don't build SaaS. Don't invest in SaaS.
Okay, thank you.